Sun TV, the stock under pressure, down almost 9% as the company reported an operational miss in the first quarter. The revenue fell 5%, while subscription revenue too dipped about 2% despite price hikes on account of NTO 3.0.
Voltas climbs more than 7% after delivering a strong showing in the Q1 numbers that were above estimates. The revenues from operations up 47% on a year-on-year basis, strong growth from the UCPS segment and sharp recovery in the EMPS segment.
The muted management commentary takes Balkrishna Industries lower despite posting an in-line set of numbers. They expect minor sales volume growth in FY25 and see tepid demand environment due to macro challenges. That too takes the stock down by about 6%.
Jubilant Food surges as the company delivers a solid set of numbers in the first quarter. The revenues increased by 10% on a year-on-year basis. Like-for-like growth stands at around 3%.
Bunch of other stocks on our radar. We have SCI, Stovecraft and Inox Wind, all of them doing well on the back of their quarterly results. Management of Stovecraft tells CNBC-TV18 they will continue to improve gross margins, while Inox Wind's management expects a significant upside to their FY26 guidance.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangalam Malu. And as the top of the screen is telling you, well, all the indices are trading in the red, but the one you should keep an eye out on is the Nifty Bank. That's on the verge of moving into the green. That dip is getting bought into. And the big boy, HDFC Bank. As said earlier this morning, that could be the stock to focus on. That one's seen a big, uptake from the low point of the day. And it's the largest constituent on the Nifty as well as on the Nifty Bank. Could explain why the Nifty Bank is on the verge of moving to the green. Hey, Mangalam.
Let's see where that goes, Nigel. You know, any softness in terms of the market is being bought into, and any recovery from the lows is looked at as an opportunity for the resilience of our markets itself, and the Nifty Bank has recovered from the lows. But let's talk about Honasa Consumer. The company reported a good set of numbers for the first quarter, 19% revenue growth led by 25% volume growth as well. Margins too improved by 200 basis points. Ramanpreet Sohi, who is the CFO of the company, now joins in to discuss the quarter gone by, but more importantly, what the near-term concerns are as well. Raman, thank you so much for joining in. The first quarter was good, no two ways about it. 19% revenue growth led by 25% volume growth as well. But, you know, one of the comments in your PowerPoint presentation when it came to the revamp of distribution has the street a little worried. In terms of inventory offsets that you are likely to do for the distribution revamp, what could the potential impact in the near term be as a proportion of your sales?
Yeah, hi, good morning. Thank you for having me. Yes, of course, like you said, of course, we had a good first quarter numbers in, and as part of our annual sort of charter, we've actually set on a project called Project Neve, where we are actually transitioning our distribution from a super stockist-led distributor model to a direct distributor model. And in the process, we've obviously completed some part of transition, but majority of the transition is going to happen in over this quarter and the next quarter. And hence, as we sort of transition and take out a layer of distribution, which is super stockist, we are accelerating the transition, and hence there is a likely impact of about 150 to 200 bips from an annual delivery perspective.
So 150 to 200 bips is the inventory correction that one is likely to see. What does that do to your annual guidance of 20% revenue growth with 150 basis points margin improvement? Do you hold on to that? And is there an upside risk to, this inventory correction that you're doing in the market?
See, so let me clarify that aspect. We are very clear that we are accelerating this transition, and we will do this all in a single quarter. And hence, the quarter that we do this in, we will see a one-off exception from a delivery of a top-line perspective and some impact on the bottom line as well. Having said that, for the rest of the quarters in the year, we are likely to go back to our guided, strong growth that we've been delivering all through, last year and in the first quarter, and also continue our margin uptrend in terms of the scale efficiencies and deliveries that we've been seeing. So, barring one quarter where we're trying to accelerate and be ready for and unlock a long-term sustainable, general trade transition potential for us, we will go back to our normal sort of strong growth on the top line, and as well improving bottom line margins as well.
All right. Hi, Ramanpreet. Good morning, and thanks a lot for speaking to us here on CNBC TV18. This is Nigel on this side. Since you briefly spoke on margins, and margins have improved over the last few quarters, what is the guidance from here on? I recall, it being just 1-2%. It improved to around 7% in the past year. Now you're at, northward of 8%. So for the year, what's the number we should work with? And the key variable when we talk about margins is the ad spends, which are in the mid 30% mark. So for the year, guidance on both these two?
Yeah, absolutely. So, as you've seen in first quarter, we've actually delivered almost 200 bips margin expansion on a year-on-year basis. And if I sort of exclude the one-time correction driven by our distribution transition, we will move back to our guidance of 150 bips margin expansion on a year-on-year basis. And this will sort of continue not only this year, but next year as well. We feel very confident in terms of how we've seen margin unfold even in Q1, given our growths. And we will continue to work towards improving margin trajectory. And there is fair bit of confidence on 150 bips margin expansion coming in. Of course, like we've sort of said in the past, as the business scales, all our brands as they scale are becoming more efficient. And a part of our margin expansion will come from A&P efficiencies that we see as our brands scale.
So what would A&P settle at? Because I remember FY24, they settled around at 34.5%. The first quarter, you've done around 36%. Competitive intensity is high as well from all quarters. So at what level do A&P spends settle?
See, very difficult to pinpoint exactly at what level, but if you actually look at our guidance of 150 pips expansion on a year-on-year basis, 30 to 40% of that should come through A&P efficiencies.
All right, so 60-70 basis points comes in from A&P efficiencies. I wanted your thoughts on two things. One, offline as a proportion of sales. Now you've reached 2 lakh stores. You are revamping distribution. Last time you joined us, you said about a third of your sales come in from offline. So going forward, what rate is offline channel likely to grow at in the overall growth of 20% that you've guided for? And new products as well. In the first quarter, it's 9%. All of last year, it was close to around 18%. So how much do new products contribute to your revenue going forward? And offline sales as a proportion of your overall revenue comes to what?
See, just to put some perspective to it, currently, of course, Mamaearth, which is the largest brand, offline channel is driven by Mamaearth, specifically our younger brands. Our second brand, which reached a 500 crore annual run rate in the previous quarter in Q4 of last year, continues to do well. And we now slowly moving that brand also in key offline accounts as well. It started with modern trade and then some key beauty counters as well. It's going to be a gradual progression as we move younger brands into offline. But typically, Mamaearth is going to lead the offline charge for us, at least in the near term to medium term. Having said that, given all our younger brands are online first brands, digital first brands, the mix of offline online is likely to be in the same ratio for the near term and medium term. And of course, as the younger brands move offline, we'll then see offline contribution to the overall business also move up over time.
Okay, all right, Ramanpreet, final question before we let you go. You have given us targets for Dermaco, 500 crores for Aqualogica, as well as Dr. Seth's, and 250 crores for BBlunt. By when do you hit all these targets?
We continue to be very positive on how these brands are being loved by our consumers. In fact, BBlunt actually reached 100 crore in annual run rate, which we've scaled almost 4x since we've acquired within 2 years. So we're very confident on how these brands are being loved by consumers, how they are doing on our online platforms. And as we take them offline subsequently, we'll see that some of these numbers that we guided over the next 2 to 3 years, we should be able to hit these run rates.
Quickly, if you could tell us, where are they right now? BBlunt, you said, is at 100 crores. Where is Dermaco, where's the Dermaco, where is Aqualogica? Where do those brands stand right now in terms of ARR?
See, we normally announce the brand milestones as they hit new milestones. Having said that, we continue to see them scale up. The last announced milestones for each of these brands were 500 crores for the Dermaco. We just announced this quarter 100 crore annual run rate, and Dr. Shade and Aqualogica are between 180 to 200 crore run rates.
All right, we look forward to them hitting the milestones that you spoke about, but more importantly, breaking even as well and contributing to the EBITDA as you're guiding for 150 basis points improvement. So the next couple of quarters may be blip because of that inventory correction to the tune of about 100-150 basis points, but thereafter 20% sales with 150 basis points margins is what you have guided for. We'll hold you on to those numbers. Thank you, Ramanpreet, for joining in and giving us those details. With that, let's shift focus to a special segment. We get you ideas for profit coming in from our colleagues at Money Control Pro. And today we have Jitendra Gupta joining in with the stock.
Given the volatility and uncertainty in the stock market, Bharat Electronics should do well. We have been bullish from the levels of around rupees 92 in September last year. Even at current levels of around 300 rupees a share, it offers good value. The company has a healthy order backlog of close to 76,000 crore, providing strong revenue visibility for the next 3 years. During fiscal 24, the company backed orders worth rupees 35,000 crore as against its earlier guidance of 20,000 crore. In current fiscal as well, the company is expecting order inflows of close to 25,000 crore, which doesn't include LRSM orders. It is a conservative estimate that the company has provided. Notable point is that the execution is quite good. In Q1, it delivered 20% growth in the revenues, and of course, because of led by strong order book and focus on exports. In terms of EBITDA margins, it has guided to achieve 23 to 25% margins, led by better revenue mix. On valuation front, I would say stock is trading at 35 times, which is quite good. More in the light of earnings visibility supported by strong order book and improving execution.
All right, Jitendra, thanks a lot for that. Take a short break, come back. On the other side, we have the management of Kirloskar Ferris. R.V. Gumaste joins in to discuss the quarter gone by.
Well, let's turn our attention to Kirloskar Ferris. The numbers actually in the past quarter were disappointing. Remember, this is a stock in the last 3 years that's moved from around 100 rupees all the way to around 700 rupees. To understand what's the way ahead from here on, we have Mr. R.V. Gumaste, who's the managing director of the company. Hi, Mr. Gumaste. Good morning, and thanks a lot for joining in. Well, let's focus first on the volumes. It's been a soft start to the year. How do you see the volume picture pan out from here on? If you could first start by telling us about casting, where there was a small growth of only around 1%, and pig iron business. What do you end this year with on both these two segments? And then for ISMT as well, the acquired entity, how do you see the tubes and the steel sales numbers go on? Please go ahead, sir.
Yeah, on the casting front first, the quarter one was very soft. Demand from tractor sector was still not really up to the mark. And also first quarter typically has been a soft quarter. And from 15th May or end of May onwards, the things have improved. Demand for castings from tractor as well as the auto sector has picked up, and definitely I look forward to much better numbers for quarter two onwards, and we should this year achieve decent growth compared to the last year figures. And
so
moving, yeah.
What is the number, sir, for castings? What is the number? I think earlier we were talking about something in the vicinity of 1.4, 1.5 lakh, I think is what we had discussed last time. What should that number look like for casting and pig iron?
No, I think for the casting, if you look at, we have two foundries in Solapur, and we are ramping up the production and sales. And second half of this year, we will have Oliver Engineering, our Punjab foundry, joining the production and sales, and we look for really more decent numbers, much better numbers towards our installed capacity now is more than 2 lakh metric ton per annum. So from
Right.
that angle, I would look for a good progress in the sales volumes from casting.
Give us a number, sir. You want to give it to us? The casting business, the casting business of the core business and all over separately as well, or you want to give it to us? If you could break it up for us. Let's get casting out of the way first.
Yeah, first casting out of the way. Our current run rate is 13,000 metric ton per month. That's what we are doing right now.
Right.
And with Oliver Foundry joining, I should add at least 1,000 tons more, and Solapur should add another 1,000 tons into quarter 3 at least. So these are the numbers we are looking at, I think, which will result into substantial growth for this year compared to last year.
So second half of the year will be 15,000 per month, 13 plus 1 plus 1, correct?
Yes, please.
So you're bracing for roughly 150 to 160,000 tons this year in terms of volumes?
See, the first thing is to cross the 40,000 per quarter. I think we are keen to look at the earliest, and subsequently we should go another 3,000 per quarter extra. We are looking at crossing more than 150,000 this year.
All right, 150,000 this year. What about margins? If you could give us a sense of blended margins in the very near term, and thereafter recovery in the second half as utilizations go up, newer capacities come in. So what kind of blended margins can you give us?
No, I think we would definitely maintain the EBITDA levels of 15% and above in casting, especially the only the pig iron has been due to entire iron and steel industry is under pressure of margins, and we continue to do that. And we are commissioning oxygen enrichment by the end of October. That should help us in increasing the pulverized coal injection, which should help us to mitigate the cost to some extent. And we are also looking for our iron ore mines to become operational, which has been the point in pending for very long, and hopefully, the light at the end of the tunnel. I expect second half that should add value to us, and thereby I think the blended margins, both the pig iron and casting, should improve in the second half of this year.
By how much?
See, it is quite dynamic. I refrain from giving numbers because they could go absolutely wrong because of the movement,
Right.
both on the product pricing. Commodity and pig iron has been very, very, unpredictable.
Okay. But, the blended margin that we are working with for as the end of first quarter is around 11%. So you're saying quarter 2 will be a little softer because pig iron prices as well will be under pressure. And then we'll see the recovery in the second half of the year. Is that correct, sir?
No, I think I expect improvement in the overall margin even for quarter 2, and quarter 3 and 4 should be better than quarter 2.
Got it. All right. So for the year, sir, should we work with an average margin of around 13-14% at least?
No, I think our effort would be to recover our 15% margin.
Got it. Oh, that'll be good news then. Superb. Also, you briefly mentioned this iron ore mines. Are they operational now? The last time around when we chatted, you said you're expecting at least 2.5 lakh tons from that iron mine, which could help you all save roughly around 40-50 crores. Is that on course?
Around the volume, first year volume would be 2.2 lakh metric ton mining and to be moved to our factories. And next year, I can expect it to go to 2.4 lakh metric ton with only one mine, which is likely to become operational shortly.
Okay. All right. Very quickly, sir, you've been talking about some capacity addition, some focus on cost saving as well. Last year, capital expenditure was around 520 crores. For this year, what is your total capital expenditure? And currently, what is the debt in its books? Where does it go to?
I think the capital expenditure even in this year would be in the range of 500 to 600 crores. Okay. And the debt levels will remain same in the range of about 800 to 1,000 crores. No major shift. I think most of the projects are getting funded with the cash we generate.
Pleasure talking to you, Mr. Gumaste. Thanks a lot for joining in here on CNBC TV18. The endeavors to move back to around 15%. You're optimistic that things improve and the debt number will hold at around that 800 to around 1,000 crores odd. Thanks a lot for joining. For the time being, the stock is under pressure. But as I mentioned, in the last few years, it's up nearly around 5 times odd. For the time being, slip in a short break, come back. We'll continue to focus on the markets that have seen a big recovery from the low point of the day. Well, on expected lines, the resilience of the Indian markets again has come into play. Take a look at the big recovery we have seen in the Indian markets, and you pull up some of these Adani Group stocks. Let's get a few of them up for you on the screen. Both the stocks that are part of the Nifty, that's Adani Enterprises as well as Adani Ports, both of them a big recovery is what we are seeing from the low point of the day. The next couple of them should come up for you as well on the screen. Adani Green has seen a good recovery. You have Adani Energy as well. Those dips on both these two have got bought into. So both of them now moving towards the high point of the day. And the cement twins as well. Ambuja Cements, by the way, has moved into the green. I recall it was down close to around 3.5%. So big recovery is what you're seeing. So in short, the Adani Group stocks have seen a recovery. HDFC Bank is leading the Nifty Bank higher. And as we speak, Mangalam, from the red that we saw at the start of the show, most of the indices are in the green. But that's it from Mangalam and myself and the entire team that put the show of Chartbusters together. Stay with us. Trading Hour comes up next.